Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we are diving deep into a really powerful and honestly often misunderstood investment philosophy. And it's all detailed in Michael Covel's fantastic book, Trend Following. Now, this is a strategy that's built on a completely different set of rules than what most of us were ever taught about the stock market. So yeah, let's get right into it. So let's start by rewinding the clock a bit to a moment I'm sure a lot of us remember way too well. It was a time that basically redefined risk for an entire generation, and it really serves as the ultimate stress test for any financial strategy you can think of. All right, picture this. It's 2008. The global financial system is, teetering on the absolute brink. Most investors are just watching their life savings get wiped out in real time. But there was this small group of traders who weren't just surviving, they were actually thriving. They weren't panicking at all. They were just executing a plan that was designed for exactly this kind of crazy, chaotic environment. Now, look at that number. That is not a typo. Some of the top trend followers saw returns as high as 40% in a single month. That was October 2008, while the rest of the world was basically melting down. Covel points out in his book that while most funds were losing unimaginable amounts of money, these guys were making fortunes. Which leads to the big question, right? How is that even possible? How can you win when it feels like the entire system is losing? Well, this whole paradox, this idea of winning big when everyone else is losing big, that gets us right to the very heart of the trend-following philosophy. See, it's not about predicting a crash. Not at all. It's about having a system in place that can profit from any big, sustained move, especially the really violent ones that cause the most panic. We're all taught the same thing, right? Buy low, sell high. It sounds simple, it sounds smart, but here's the problem. That advice becomes a trap during a major market crash. Every time you buy the dip, you're really just catching a falling knife, and the next low is always even lower than the last one. And, like Charles Faulkner asks here, what are you supposed to do at an all-time high or an all-time low? That question just cuts right to the core of the problem with that conventional wisdom. Okay, so what's really fascinating here is just how different the two approaches are. Conventional investors, they try to predict the future. They use something called fundamental analysis, digging through earnings reports, economic forecasts, to try and figure out a company's true value. Trend followers, they ignore all of that, literally all of it. They use technical analysis, which just means they look at one thing and one thing only, the price. They don't care why a market is moving, just that it is moving. They don't buy low. In fact, they often buy at new highs, betting the trend is going to keep going. And this is crucial. They don't fear volatility. They absolutely need it to catch those massive trends. It's like conventional investors try to predict the rain. Trend followers just react when they start getting wet. So, if buying the dip is a total trap, what's the alternative? Well, the answer is in a philosophy that completely gives up on the idea of being a fortune teller. It's really a beautiful, simple concept, and Van Tharp explains it perfectly here. Just stop trying to guess the bottom or the top. Stop trying to outsmart the market. Instead, you just wait. You wait for a clear direction, a trend to show up, whether that's up or down. And once the price action itself establishes that trend, you just get on board. You ride it for as long as it lasts. You're not the engine trying to power the train. You're just the caboose, happily along for the ride. And this quote, man, it just perfectly illustrates the mindset. It's from the legendary trend follower Bill Dunn, and there's a good reason it's on the cover of Covel's book. The market, it's an untamable beast. It's wild, it's unpredictable, it's powerful. The goal isn't to tame it or guess its next move, but to have the skill, the system, and the discipline to just stay on for the ride, whether that bronco is bucking up or down. So how do you actually ride that bucking bronco? Well, it all comes down to the absolute bedrock of the strategy, 2 simple rules that make everything else possible. Now, they're super simple to understand, but as we're about to see, they're incredibly difficult for most people to actually do because they go against pretty much every human instinct we have. Rule number 1 is all about survival. It is pure defense. If a trade goes against you, you get out, period. There's no hoping, no praying, no waiting for it to come back. You have a predefined exit point, your stop loss, and if the price hits it, you cut that loss, you do it quickly, and you do it without emotion. This is what keeps a small acceptable mistake from turning into a catastrophic portfolio-destroying disaster. And then there's rule number 2. This is where the big money comes from. This is your offense. When a trade is working, You have to fight that overwhelming human urge to just snatch a small, quick profit to feel good. You have to stay with the trend, ride it through all its ups and downs so you can capture the majority of a major market move. It's these few huge, outsized winners that end up paying for all those small, disciplined losses you took following rule number 1. Legendary trader Larry Hite just nails the psychology here in the book's foreword. Our brains are basically wired completely backward for trading. It feels good to be right, so we take our profits way too early, and it feels awful to be wrong, so we hold on to our losers just hoping they'll turn around and prove we were right all along. Trend following is a system designed to short-circuit that flawed human wiring. It forces you to do the exact opposite, accept lots of small, emotionally painless losses so that you can be in a position to capture a few enormous, life-changing wins. So we've got these 2 unbreakable rules. But, let's be real. Do they actually work? When the bullets are flying and panic is in the air, does this totally counterintuitive approach actually hold up? Well, the history is pretty compelling. Time and time again, during the biggest market panics of the last few decades, trend following has shown its true power. When those Nobel Prize-winning geniuses at long-term capital management blew up the financial system back in '98, trend followers made money shorting the markets that were collapsing. When the dot-com bubble burst from 2000 to 2002 and just devastated tech investors, trend followers rode that downtrend for massive gains. And, like we saw during the 2008 crisis, they had some of their best years ever. The pattern is clear. When traditional buy-and-hold portfolios get crushed, these systems often generate huge positive returns. And look, this isn't some fluke performed by one lucky person. It's a really robust discipline that's been mastered by a whole group of incredibly successful traders over many, many decades. Covel's book is filled with profiles of these legends, from pioneers like Jesse Livermore way back in the early 20th century to modern titans like David Harding and John W. Henry, who famously used his trading profits to buy the Boston Red Sox. Their consistent success just shows the enduring power of this philosophy across different times, different people, and different markets. So ultimately, trend following is way more than just a set of trading rules. It's really a complete shift in how you look at the markets and how you manage risk. It's a philosophy for dealing with a world that is fundamentally uncertain. So it all comes together in this 4-part philosophy. First, price is everything. It's the only truth because it reflects all known information. You have to ignore the news, the pundits, all the noise. Second, you always put risk first. You have to know your exit before you even think about getting into a trade. It's defense before offense, always. Third, you embrace uncertainty. You accept that you can't predict the future, and more importantly, that you don't even need to. And finally, and this is the most critical part, you follow the system with just iron-willed discipline, because that system is designed to protect you from your own worst enemy, your emotions. Just like John W. Henry says here, discipline and paying attention to reality, that's everything. This isn't about your ego. It's not about being some kind of genius who can predict the future. It's about having a solid plan designed to profit from uncertainty and then having the guts to execute it flawlessly, especially on the days when it feels the hardest to do. And that really brings us to the final takeaway, a question that kind of reframes the entire purpose of investing and our relationship with the chaotic, totally unpredictable nature of the markets. It really is a profound shift. You go from trying to be a fortune teller to becoming a master of risk and reaction. One path is filled with the anxiety of constantly needing to be right. The other is about the discipline to just follow a process. So the question is, which boat are you in? Thank you for joining us for this explainer.
Welcome to the Explainer. Today we're going to unpack a trading philosophy that's disciplined, often completely counterintuitive, and it's called trend following. It's an approach that basically challenges everything the average person thinks they know about how markets work. And honestly, it might just change the way you see investing forever. But before we dive into the how, we really need to understand the why. Why does this philosophy even exist? To get there, we have to talk about a very common and, let's be real, a very painful experience. It's the roller coaster that the typical investor finds themselves on just trying to navigate the financial markets.
So I want you to ask yourself, and be honest, have you ever felt this way? Because for millions of people, the cycle of hope and then, despair that we're about to walk through isn't just some hypothetical idea, it is their financial reality. So picture this, you're feeling great, your portfolio's looking good, and then, bam, a bubble bursts. The dot-com crash, 2008, take your pick, and you lose a huge chunk of your money. So then you get angry, right? You're mad at the so-called experts you trusted. You're completely paralyzed with fear about your 401k. And you start to think, you know what? Maybe winning in the market is just pure dumb luck. This whole cycle, this is what our source material calls the market loser's profile.
Okay, now this is where it gets really interesting. Look at the contrast here. On one side, you've got that reactive, emotional mindset of the loser. You know, blaming everybody else, always chasing the next hot tip, completely stuck in the past. But on the other side, the potential winner. They see a loss and think, okay, what can I learn from that? They trust their own decisions, and this is crucial. They get out of a bad trade immediately. They treat the whole thing like a business, not a casino. It's a totally different mindset.
And that shift in mindset, it really starts with a change in how you see yourself. See, most people call themselves investors, but the most successful people, the ones we're studying today, they call themselves traders. Let's break down why that one little word makes such a huge difference. An investor pretty much just buys something and hopes its value goes up over time. It works great when markets are flying high, but when things go down, they don't have a plan. They just hold on and hope. But a trader has one single goal: profit. They couldn't care less what they own, they only care about the result. And they have ways to profit in any market, which includes selling short, basically betting that a price will go down. And that ability to make money when everyone else is panicking and losing, that is an absolute game changer.
So if you're going to start acting like a trader, how do you actually look at the market? You know, Wall Street is just constantly screaming at us with information, PE ratios, breaking news, expert opinions. Trend followers argue that almost all of that, it's just noise. They use a completely different way to find the real signal.
So almost everyone on Wall Street is playing one game. It's called fundamental analysis. They study all these external things to try and predict where the market is headed next. The problem is, they're wrong. A lot. Trend followers play a totally different game. It's a type of technical analysis. They don't predict, they react. They believe the price you see on the screen already reflects all that fundamental stuff. So instead of guessing the future, they just follow what the price is actually doing right here, right now.
You know, the legendary trader Ed Seykota told this brilliant story that just perfectly nails the flaw and all that fundamental thinking. It all starts at a simple dinner when a sharp knife gets knocked off a table. So the fundamentalist analyst, who's trained to evaluate and predict everything, he does what he does best. He just analyzes. He watches the knife fall, probably calculating its trajectory, thinking about the velocity, but he doesn't do anything. He's totally paralyzed by his need to understand the why instead of just reacting to the what. And here's the punchline, and it is just perfect. I was waiting for it to come back up. I mean, how many of us have said that about a stock that's tanking? The fundamentalist is just stuck, hoping a bad situation will magically fix itself. A trend follower would have reacted to the reality of the falling knife and, moved their foot.
Okay, so if you're going to ignore all that noise, the news, the earnings reports, the talking heads on TV, what are you even left with? What is the one single thing that connects every single market in the world, from crude oil to Google stock? The answer is price. That's it. Price is the one and only objective truth. Think about it. Annual reports can be cooked. Expert opinions can be totally biased. But the price is the price. It's the final, non-negotiable result of what every buyer and seller in the world is doing. And for a trend follower, it's the only thing that actually matters.
And another great trader, William Eckhart, he put it perfectly. If price is what determines whether you win or lose, then price should be the only thing you bother studying. Everything else is just a distraction. So, how do you take this obsession with price and build it into a concrete set of rules?
Right, so this focus on price isn't just some vague theory. It is the absolute foundation for a rigid, mechanical rule book. Trend following is all about replacing our subjective, messy human emotions with objective, unemotional discipline.
This right here is the central mantra. It sounds so simple, right? But it forces you to fight against your own human nature. We are literally wired to hold on to our losers, just hoping they'll come back. And we're so quick to sell our small winners because we're afraid they'll disappear. Doing the exact opposite, cutting those losers quick and letting the winners grow big, that's the whole secret.
And this leads to this huge split in how people approach trading. You have discretionary traders who rely on their gut feelings, their hunches, their interpretations, and this just opens them up to all kinds of emotional mistakes. Then you have trend followers. They are mechanical traders. They use a predefined system of rules. The question is never, what do I think? It's always, what does my system say to do? This takes the emotion right out of the equation and forces you to be consistent.
And look, this isn't just some friendly suggestion, it is an absolute law. Major trend-following firms, huge ones like Campbell & Company, they say flat out that their refusal to use discretion to override their system is one of their biggest strengths. The rules are the rules, period. Okay, so I get it. We've got this counterintuitive, rules-based system that tells you to ignore all the news. It sounds radical. So, the next logical question anyone would ask is, does this stuff actually work? Let's look at the proof and the really deep philosophy that's behind it all.
Because, for any strategy to be worth anything, it has to deliver results over the long haul, right? Through all kinds of different markets. So what does the data actually say?
So what you're seeing here is a chart that compares a hypothetical index of major trend-following firms against the S&P 500 stock index, and this is over almost 2 decades. The difference, well, it kind of jumps right off the page, doesn't it? One line just sort of plods along, while the other one just goes almost vertical.
Let's put some hard numbers to that visual. $1,000 in the S&P 500 grew to just over $6,000. Not bad. But that same $1,000 in the trend-following index, it grew to nearly $48,000. I mean, it's not just a small difference. That is a completely different universe of returns.
So why? Why does it seem to work so well? I think the answer really lies in this famous quote from Darwin. Trend following is built on one single powerful idea. The only thing that is constant in the markets is change. Markets go up, markets go down, they go sideways. The strategy isn't built for just one type of weather. It's built to adapt and profit from change itself. And we'll end with this thought from the legendary trend follower John W. Henry. Because at the end of the day, this entire philosophy is about removing our all-too-human biases. It's about letting go of what you think should be happening and focusing only on what is happening, as told by the price. By quantifying reality and then acting on it without emotion, you gain a massive advantage. So the real question is, can you unlearn what you think you already know?
Welcome to The Explainer. Today, we're diving into the world of some real market mavericks, the great trend followers. These are the traders who made absolute fortunes by using a strategy that, honestly, flies in the face of just about every piece of financial advice you've probably ever been given. And we're kicking things off with this quote from the legendary investor Jim Rogers, because it really hits the nail on the head. The strategy we're breaking down today, it takes a kind of discipline, a kind of dedication that's almost inhuman. It's all about committing to a system so completely that your own emotions just don't get a vote. All right, here's what we've got on tap. First, we're going to meet the traders themselves. Then, we'll unpack their systematic approach. After that, we'll get into how they handle insane volatility. We'll look at their incredible performance numbers. And finally, we'll boil it all down to the core mindset. So let's jump right in. So who exactly are we talking about here? Well, we're looking at people like David Harding, Bill Dunn, John W. Henry, and the absolute legend Ed Seykota. Now, these are not your typical Wall Street guys trying to predict next quarter's earnings. Nope, these guys are thinkers, mavericks who built their own systems from scratch, basically tuning out all the noise from financial news and so-called experts. And one of the biggest differences is how they see the world. They're not specialists in, say, oil or coffee beans or the euro. They're generalists. They get that the world is this giant interconnected web because the same human emotions, fear and greed, they wash over every single market. A panic in Asian stocks could spark a trend in gold, which then ripples into the value of the Swiss franc. They see the entire forest, not just one or two trees. And this quote right here, man, it gets right to the heart of their whole philosophy. David Harding just nails it. Most of us, we crave certainty, right? We want a crystal clear buy this or sell that signal. But trend followers, they do the exact opposite. They build their entire strategy on leaning into uncertainty, on navigating all those shades of gray, because that's where they believe the real money is made. So that leads us right into the next huge idea, their total, unshakable faith in a system. This has nothing to do with gut feelings or hot tips or reacting to some breaking news story. It's about letting a pre-programmed mechanical set of rules make every single call, taking that flawed human emotion completely out of the picture. And here's the kicker. While markets are always changing, with new tech and new products, these traders believe that the engine underneath it all, human psychology, it doesn't change one bit. The same biases that make people pile into an investment and then panic sell at the bottom have been driving markets for centuries. And that's exactly why the systems they built decades ago are still so powerful today. This quote from John W. Henry's firm just doubles down on that idea. For them, constantly tinkering with a strategy isn't about making it better. It's a sign that you don't really have confidence in it. They did the hard work, they built the system, and now their job is just to execute it flawlessly, year in, year out. So check this out. This is basically the playbook for a system like John W. Henry's. It's a super clear 4-step process. First, you identify the big, long-term trends, not all the daily chatter you see on TV. Second, you follow the process with robotic discipline, no exceptions. Third, you manage risk with a strict mathematical formula, so no single loss can ever knock you out of the game. And fourth, you diversify across the globe to catch trends wherever they pop up. You notice what's missing from that list? Predict the future. It's not on there. Okay, now we get to the part that really messes with most people's heads. To win big with this strategy, you have to get really, really comfortable with losing. And I mean losing often. Those small, managed losses aren't a mistake to be avoided. They're the price of admission. They're what you pay to be in the game when those huge, profitable trends finally take off. So at its heart, this is what they're doing. It's a reactive game. They don't try to be heroes and buy at the absolute bottom or sell at the tippy top. They wait for a market to show his hand, to start trending up, and then they hop on for the ride, buying high, fully expecting to sell way, way higher. And on the flip side, when a market starts to tank, they'll sell short, which is just a way of betting that the price is going to keep on falling. They're just momental surfers, plain and simple. Okay, take a look at these 2 charts from Bill Dunn because they show the reality of this perfectly. Let's look at the left chart first. That's the Japanese yen. The system spotted a massive downtrend, signaled go short, and after a couple small trades, it caught the big wave down for huge profit. Simple enough? But now look at the right chart. This is the British pound. The market was a total mess, just chopping sideways with no clear direction. The system tried to find a trend, it went long, it went short, but it just kept getting knocked out for small, manageable losses. That's the Bronco trying to buck him off. And here's the key. That one gigantic win on the yen paid for all those little annoying losses on the pound, and then some. A lot, then some. And Bill Dunn's quote here is just the perfect metaphor for what we just saw. Those choppy markets, like with the British pound, that's the Bronco trying to throw you. You're going to get a little bruised, you'll take some hits. Those are all the small losses. But if you can just hang on tight, eventually that Bronco is going to pick a direction and it is going to run. And that's the profitable trend you've been waiting for all along. So look, all of this sounds pretty cool in theory, right? Embracing losses, riding Broncos. But does this crazy ride actually work? Well, let's look at the numbers, because the long-term performance data is, and I'm not exaggerating here, it's mind-blowing. All right, but here's the million-dollar question, isn't it? How does this stack up against the advice we all hear a million times? Just buy an S&P 500 index fund and forget about it. Well, as you're about to see, the difference isn't just a little bit. It is monumental. Okay, first up, Bill Dunn. Over this nearly 20-year stretch, if you put $1,000 in the S&P 500, it would have grown to about $6,400. Not bad, right? A respectable return, but that same $1,000 with Dunn's trend-following strategy, it would have exploded to over $26,000. We're talking more than 4 times the return. That's not just beating the market, that's playing a completely different game. And if you thought that was impressive, get ready. This next chart shows the explosive potential even more. So same time period, same S&P 500 benchmark. But with John W. Henry's system, that initial $1,000 would have turned into over $136,000. I'm going to say that again, $136,000. That is not a typo. It's more than 20 times the performance of the stock market. Just wow. But maybe the most incredible feature of trend following is how it does when everyone else is running for the hills. See, a market crash is just a really strong trend downward, so their systems love it. In 2002, after the dot-com bubble popped, David Harding's fund was up over 18%, and in the absolute chaos of the 2008 global financial crisis, when most people's accounts got vaporized, he was up 21%. Big moves, up or down, that's where they make their money. Okay, so let's wrap this all up by talking about the core mindset, because really, this is more than just a trading strategy. It's a completely different way of looking at the world and dealing with a future that you know is uncertain. And this slide just lays it all out, side by side. The conventional investor, They want certainty. They're always trying to predict what's next, they hate volatility, and they are terrified of being wrong. The trend follower? They do the exact opposite on every single point. They embrace uncertainty, react to what's happening right now, they see volatility as an opportunity for profit, and they totally accept that being wrong often is just a normal part of the process of being right in a really, really big way. And this last quote from Ed Seykota. Man, this one is a real thinker. He's basically suggesting that whatever results you get from the market are actually giving you what you want on a deep psychological level. Some people, maybe they need the drama of losing. Others need the ego trip of being right, even if it costs them a fortune. Seikota's making us ask ourselves what we're really after. So this all boils down to one final question, and this one's for you. When you look at the market, what do you truly want from it? Do you want the adrenaline rush of a gamble, the false comfort of a prediction, or are you willing to embrace the kind of discipline and uncertainty that's required for a system built for long-term success? Answering that question honestly is the real first step. And that's our explainer for today.
You know how it is. When it comes to trading, everyone has an opinion. Everyone's got a hot take, a theory, a can't-miss system. But today, we're cutting through all of that noise. We're going to deconstruct the real, raw, unfiltered performance data of some of the world's most successful traders to see what actually works. Okay, let's dive in.
In that classic line from Cool Hand Luke, it just perfectly nails the state of mainstream trading wisdom. There is a massive, fundamental miscommunication about what real success looks like, what risk truly is, and how the top performers actually make their money. It feels like the truth is just out of reach for most people.
See, anybody can talk a good game. They can sound smart on TV or write a convincing newsletter. But at the end of the day, the only thing that actually matters is the bottom line. The numbers on the page. The data doesn't have an opinion. It's the ultimate truth teller. So for the next few minutes, we're going to treat this like a science. We're looking at the proof, the hard evidence that pulls back the curtain on legendary performance.
All right, first up, let's tackle our first huge idea, moving beyond the benchmark. For what feels like forever, the entire financial world has been completely fixated on one thing, beating the market, right? It always comes down to comparing your performance to something like the S&P 500. But what if that entire way of thinking is just wrong from the start? Let's challenge that obsession.
So let me just ask you this straight up. Is that really the peak of the mountain? Is the ultimate goal just to lose a little bit less than an index when the market tanks, or to make a little bit more when it's going up? Well, the traders we're about to look at would give you a very loud, very clear no.
In this slide right here breaks down the core difference in mindset. On one side, you have relative returns. That's the whole benchmark world. Your goal is simply to perform relative to something else. But on the other side, you have absolute returns. And the goal here is way simpler and way more powerful. Make as much money as possible. That's it, in any market, up, down, or totally sideways.
Now check out what happens when you adopt that absolute return mindset. Just look at these numbers. Over a decade, these top trend followers weren't just squeaking by the market by a percentage point or two. They were compounding returns at rates that are just mind-blowing. Eckhart Trading, over 1,600% compounded. Dunn Capital, over 1,100%. This isn't playing the same sport. It's a completely different game. And here's the kicker. The vast majority of those traditional mutual funds, the ones who live and die by relative returns, they don't even win their own game. An incredible 80% of them fail to beat their own benchmarks. So not only are they playing a limited game, they're losing at it.
This quote from the legendary trader John W. Henry just says it all. The top dogs, they don't chain themselves to an index. Their one and only goal is to make money in all market conditions. They're not trying to keep up with the herd. They're running their own race for pure profit.
So if these top traders aren't tied to a benchmark, what is it that allows them to get those incredible returns? Well, that brings us to our second big truth, and this one's all about volatility. It's a word that terrifies most investors. We've all been taught that it's just pure risk, something you should run away from. But what if that's a huge misunderstanding? What if volatility isn't the enemy at all, but the actual engine for profit?
When you boil it down, volatility is just this. Prices changing unexpectedly. That's it. It isn't good, it isn't bad, it's just a state of the market. But for trend followers, these unexpected changes, these big swings, they're not a threat. They are the opportunity itself. Think about it. No volatility means no trends. And if there are no trends, there's no profit to be made.
Okay, this is where things get really interesting, because the typical ways we're told to measure risk are often just dangerously wrong. Take a look at this. Dunn Capital, a firm that's been wildly successful for decades, got a low-risk rating of 1 star because its returns were volatile. Meanwhile, Victor Niederhoffel, right before his fund famously blew up in a spectacular fashion, was rated a much safer 4 stars. The system literally penalized the long-term winner and rewarded the guy about to go bust, all because it mistook volatility for actual risk.
And here's the secret reason why that's so backwards. Research clearly shows that for trend followers, the volatility is skewed to the upside. Because they are ruthless about cutting their losses short, the big, crazy, unexpected price swings are far more likely to be huge winning trades in their favor, not catastrophic losses. And your standard risk models, they completely miss this critical distinction. But let's be real. It's one thing to understand this stuff on paper, it's another thing entirely to live through it. And this quote from Jason Russell just cuts right to the bone. He calls it the volatility threshold, that gut-wrenching point where the emotional pain of the swings makes you just give up and sell everything, no matter what the charts or the math say. Managing your own emotions through that is just as critical as managing the trades. And that emotional pain, that volatility threshold, it's never more real than during a losing period. And that brings us to our third section, embracing the drawdown. This is, hands down, the hardest part of trading for almost everyone. But instead of seeing these losing streaks as a failure, the pros see them as just the cost of doing business. It's the price of admission you absolutely have to pay if you want a ticket to those big gains. So let's be super clear about what we're talking about. A drawdown is just the drop in your account from its highest point down to its lowest point. Simple as that. If your account goes from 100 grand up to a new peak and then falls back to 75 grand, you're in a 25% drawdown. It's the painful journey through the valley between the peaks. Now look at this chart. This is the real unfiltered performance of Dunn Capital. This is what world-class trading actually looks like. It is not a smooth line going up and to the right. It is a jagged, brutal, heart-stopping climb. Look at those drops. You had to live through a 43% loss, a 52% loss, another 40% loss, just to get to the end result. Most people would have tapped out. They would have sold in panic in one of those valleys, and they would have missed the incredible new highs that came right after. This chart is the volatility threshold made visible. And the math behind these drawdowns, it is just unforgiving. It's brutal, and you have to understand it. A 10% loss only requires an 11% gain to get back to where you started. No big deal. But a 50% loss requires a 100% gain. You have to double your remaining money just to break even. A 90% loss requires a 900% gain. This is exactly why cutting your losses isn't just a friendly suggestion, it is the absolute key to survival.
And hey, if you think drawdowns are just for trend followers or some other niche strategy, think again. During the 2008 financial crisis, the so-called major league legends of investing got absolutely hammered. Warren Buffett, down 43%. Ken Hebner, down 56%. And Carl Icahn, down a staggering 81%. The pain happens to everyone. The real difference is having a strategy that can recover and climb to new highs.
And now, this quote from the great Tom Basso completely flips the entire conversation on its head. While the average investor is freaking out and selling during a drawdown, the pros see something completely different. They see an opportunity. They know their system works over the long haul, so a drawdown is like their entire strategy going on sale. They're not running away from the fire, they're leaning in, ready for the comeback. It's the ultimate contrarian mindset.
So, what have we learned? We've seen that top traders ignore benchmarks, they embrace volatility, and they even see drawdowns as a buying opportunity. So what's the fundamental truth that allows this mindset to be so ridiculously profitable? Well, this brings us to our final section, and it might be the most important and most difficult truth of them all. It's the brutal reality of the market that underpins every single decision these traders make.
So first, take a look at this. This table shows the performance correlation among the turtle traders. If you don't know the story, it was a famous experiment where a group of total novices were taught the exact same trend-following system. And what you see here are high positive correlations. That means they were all winning at the same time and losing at the same time. This is powerful, powerful proof that success isn't some magical gut feeling. It is the disciplined application of a repeatable system of a statistical edge.
And that edge operates in a very specific environment. In futures markets, trading is a zero-sum game. Think of it like a poker game. For every single dollar that you win, someone else sitting at the table has to lose exactly $1.
There's no new value being created in the pot. Money is simply being transferred from the losers' accounts to the winners' accounts. This quote from a judge, of all people, ruling on a dot-com bubble lawsuit. It might be one of the most blunt, honest descriptions of the market you will ever read. He calls it a freewheeling casino, where the money lost by the unlucky is now held by the lucky winners, fair and square. The market isn't your friendly neighborhood savings plan. It's a competitive arena, a battlefield for profit.
So we'll end with this one, simple question. If trading is a zero-sum game and you are going to win, if you're going to use your edge to make a profit, that profit has to come from somewhere. It comes from the pockets of those who don't have an edge, who trade on fear and greed, who are forced to hedge, or who are simply on the wrong side of a powerful trend. So the most important question you have to ask yourself is this: do you know what your edge is? And who exactly is funding your profits?
You've seen the headlines, right? Every time a market crashes, it's the same story. Panic on the trading floor, fortunes completely wiped out, life savings gone. The media just loves a disaster story. But here's the thing, that's only half the story. So today, we're going to ask a different question. In the zero-sum game of the market, if someone is losing a fortune, someone else has to be winning it. So who are they? So let's kick things off with this fantastic quote from legendary trader Larry Hite. This just cuts right to the heart of it, doesn't it? It completely challenges that old-school academic idea that markets are perfectly rational and efficient. Hite's basically saying, hey, maybe the world isn't so neat and tidy. He's suggesting that there's a real edge to be found, especially when things get completely chaotic. I mean, think about it. Anytime there's a big financial blow-up, like the 2008 crisis, all the news stories are about the people who lost everything. You see the dramatic photos, you hear these tragic stories of ruin. It's a powerful narrative for sure, but it's totally one-sided. And that's the central question we're going to dig into. If someone loses $1 billion, that money doesn't just poof, disappear into thin air. It has to go somewhere, right? Someone is on the other side of that losing trade, and they're winning. So who are these people? And maybe more importantly, how in the world do they do it? Okay, to get to the bottom of this, we have to start with a fundamental rule of the game. For every loser in these markets, there absolutely has to be a winner. It's what's known as a zero-sum game. It's a really simple idea, but its implications are huge. You know, for every trader who famously blows up their firm by making massive losing bets, there had to be somebody else out there taking the exact opposite side of that bet and making an absolute killing. It's a direct transfer of wealth. One person's loss is literally another person's gain. And hey, it's not some crazy theory. Even top academics know this is how it works. As Professor Christopher Colt points out, we know the winners are out there. The tricky part is that they're usually quiet. They're flying under the radar, while the media shines this huge spotlight on all the losers. Well, today we're pulling back the curtain. We're going to get very specific. The winners in pretty much every major market meltdown for the past 30 years belong to a specific group. They're called trend followers, and they don't operate the way you think traders do. They don't have crystal balls, they don't predict the economy. They have a totally different system, one that's actually built to thrive on the very chaos that destroys everyone else. All right, let's look at a case study. And what better place to start than the big one, the 2008 global financial crisis. We all remember it. For most people, it was an unmitigated disaster. It's the perfect event to see this dynamic in action. Just look at this number. From late 2007 through the fall of 2008, the S&P 500, a benchmark for the whole U.S. stock market, just cratered. It fell 36%. Trillions of dollars in retirement accounts and investment portfolios just vaporized, especially for anyone who was told to just buy and hold for the long run. But while the rest of the world was in a full-blown panic, trend followers were having a slightly different year. During that exact same period, John W. Henry's fund was up 72%, Clark Capital was up 82%, and get this, Paul Mulvaney's fund was up over 45% in the single month of October 2008 alone. The worst month for everybody else, so how is that even possible? Well, there was no magic bullet. It wasn't one single lucky bet. They were trading in dozens of markets all over the world. A huge win for them came from crude oil. See, as the global economy ground to a halt, the demand for oil just fell off a cliff. Trend followers didn't need to predict that. They just saw the price starting to fall and fall hard, so they sold short, which is basically betting the price will go down. and they rode that trend all the way from over $140 a barrel down to $80. And this is a great example of their global approach. It wasn't just about what was happening in the US. As the crisis went global, they saw the same kind of downward trend happening in Japan's Nikkei stock index. So what did they do? They followed their rules, went short, and profited from the panic in Asia too. They literally just follow the trend wherever in the world it shows up. Now, this is super important. It wasn't all about betting against stuff and profiting from doom and gloom. As investors panicked and sold their stocks, where did all that money go? Well, they ran for cover. They poured it into the safest thing they could find, U.S. Treasury bonds. And that created a massive upward trend in bond prices. So trend followers saw that trend and went long. They bought bonds and profited from the flight to safety. Up, down, they don't care. They just follow the strongest trends. Okay, so that was 2008. But was it just a fluke, a one-off? Well, let's rewind the clock a few years to another infamous crash, the dot-com bust, the tech bubble that wiped out a whole generation of investors. Was it the same story? You guessed it, same exact playbook. In 2002, while the S&P 500 was down 23% and the tech-heavy NASDAQ was getting absolutely crushed, down over 31%, trend followers like Bill Dunn and John W. Henry were posting huge gains, up 54%, up 45%. The pattern is just undeniable. When traditional investing gets hammered, this strategy thrives. Now, to really drive this whole zero-sum idea home, let's zoom in even further. Let's look at one of the most notorious corporate collapses in history, Enron. The Enron story is like a perfect little snow globe of this entire concept of winners and losers. So on one side, you have the losers. These were the people who bought the Enron hype, hook, line, and sinker. They held the stock as it soared to almost $90 a share, and then they just kept holding it as it fell to 80, then 50, then 20, all the way down to pennies. I mean, the price chart itself was waving a giant red flag, basically screaming, "Get out!" But they were stuck on the story they wanted to believe. And don't think for a second this was just small-time investors. We're talking about some of the biggest, most respected mutual funds in the world. Fidelity, Janus, Morgan Stanley. The smart money. They're armies of highly paid analysts who were supposedly doing all this deep research, held on all the way down, and lost billions for their clients. So where were the winners in all this? Well, the trend followers weren't digging through Enron's fraudulent accounting books. They probably couldn't even name the CEO. They were just trading the price, specifically the price of natural gas, a market that was tied directly to Enron's business. They saw natural gas going nuts, so they rode that massive trend up, and when it finally broke, they turned around, shorted it, and rode the massive trend right back down. They made a fortune on the exact same volatility that destroyed everyone else. Okay, so by now you're probably thinking, this sounds amazing, but how do they actually do it? What's the secret? Well, the core philosophy is actually pretty straightforward. And a key is, it's all about reacting, not predicting. It really boils down to 4 simple but super powerful steps. First, they identify the trend. They're not guessing. They use strict, rules-based systems to see if a market's price is clearly moving up or down. Second, they take a position. If the trend is up, they buy. If it's down, they sell short. It's really that black and white. Third, and this is the absolute golden rule, they manage risk. Every single trade has a preset exit point, a stop loss. If the trend turns against them and hits that price, they're out. No emotion, no second guessing. This prevents a small loss from ever becoming a disaster. And finally, number 4, they ride the trend. As long as the market is going their way, they do nothing. They just stay in and let their profits run. It's like catching a wave when you're surfing. You just ride it until it's over. It all comes down to that old saying, cut your losses short and let your profits run. You see, at the end of the day, this is so much more than just a trading system. It's a completely different worldview. It's the polar opposite of the philosophy that led to famous disasters, like the spectacular collapse of the hedge fund long-term capital management, or LTCM. Think of it like 2 competing philosophies. On the left, you've got the convergent view of those Nobel Prize winners at LTCM. They truly believed the world was stable, that they could predict it, and that prices would always snap back to some rational average. Their strategy was famously called picking up nickels in front of a steamroller. And in 1998, bam, the steamroller hit. Then, on the right, you have the divergent view of the trend followers. They start with the complete opposite assumption, that the world is uncertain, unstable, and that prices can go way further than anyone thinks is rational. For them, those big, unexpected surprises aren't something to fear. They're the main source of profit. And that brings us to the final and I think most important question. What is real risk? Is it the strategy that bets on a calm, predictable world only to get completely obliterated when the inevitable surprise happens? Or is it the strategy that accepts from the very beginning that the world is uncertain and is actually designed to profit from the panics and crashes that everyone else is terrified of? Which one, in the end, is truly the rational approach? That's something to think about. All right, let's talk about something that connects the sound of a baseball hitting the bleachers with the chaos of the stock market. It's this idea called the Babe Ruth effect, and it's all about how swinging for the fences and, being totally okay with striking out might just be the secret to winning and winning big. You gotta love this quote from the man himself. It's not just about hitting a baseball, right? It's a full-on life philosophy. Babe Ruth totally got that if you want massive success, you have to be willing to accept the chance of an equally massive failure. It's this kind of all-or-nothing thinking that we're really going to get into today. So, here's what we've got lined up. We're going to start by breaking down what the Babe Ruth effect actually is. Then, we'll jump over to the world of finance to see how legendary traders are swinging for financial fences. After that, we've got two amazing case studies from baseball, Moneyball and the Red Sox. And we'll see a nail-biting showdown between data and gut instinct. And finally, we'll wrap it all up into a powerful mindset you can actually use. So let's get right to it. What in the world is the Babe Ruth effect? Well, it's this kind of wonderfully weird, counterintuitive idea. I mean, we're all taught to avoid failure, right? Play it safe. But what if leaning into failure was actually the fastest way to win? Okay, here's the whole idea in a nutshell. It's a really simple but incredibly powerful bit of math. The value of one single, giant, game-changing win is so huge that it makes all the little misses, all the strikeouts that came before it, completely irrelevant. It's not about how often you win, it's about how big you win. And this table, this just lays it all out perfectly. The numbers tell the story. A .342 batting average, that's incredible. But flip it around, it means he didn't get a hit almost 2/3 of the time. He struck out a ton. But honestly, who cares? His 714 home runs and that monster .690 slugging percentage prove that when he did connect, it was legendary. The strikeouts were just the price you had to pay for the home runs. And this quote right here just shows you where his head was at. He didn't see strikeouts as these big, terrible failures. Nope. To him, they were just part of the process. They were data points. Every swing and miss was just getting him one step closer to the one that really mattered. That mental game, that reframing of failure is absolutely everything. Okay, so let's take this idea from the ballpark and walk it over to the trading floor. Because it turns out that some of the most successful investors out there think exactly like Babe Ruth. They're not playing for these tiny, consistent little gains. No way. They are swinging for the financial fences. And here's our first expert from the world of finance, the legendary trader Richard Dryhouse. He's pretty much throwing out that old advice to just hit a lot of singles. He says the real money is in the home runs. But, and this is key, look at that second part. He has a discipline to avoid striking out too badly, which means cutting his losses. He doesn't let one bad trade ruin him. He just gets ready for the next one. And here's another giant in the trading world, Ed Seykota, saying the exact same thing. It doesn't pay to hedge your swing. This is all about conviction. When you see the perfect pitch coming, you don't just tap at it, you go all in. And that high conviction approach, that's a classic move for the world's best trend followers, the traders who make big bets on big market moves. I love this slide because it makes the whole idea so real. You've got blue-collar Joe on one side, steady, predictable, safe. His win rate is basically 100%. Then you've got the entrepreneur on the other side, our home run hitter. Her win rate? It's awful. Most of her ideas fail. She's striking out all the time. But that one idea that connects? Oh man, it changes everything. It's the difference between a good life and having total control over your own destiny. Okay, time for our first big case study. This one is a perfect example of this clash between old-school gut feelings and a brand-new, data-driven home run philosophy. You've probably heard of it. It's the story of Billy Beane and the Oakland A's, from the book and movie Moneyball. So you have to understand the situation. Billy Beane was running a team with a tiny, tiny budget, and he had to compete against behemoths like the New York Yankees. He couldn't afford the big-name superstars. So what did he do? He turned to data. He adopted this statistical approach called sabermetrics that basically ignored all the old-school wisdom and focused only on what the numbers said would actually win games. So what did all this data tell him? Well, forget the flashy plays and the stats your grandpa talked about. Winning was simple. First, get guys who get on base. Doesn't matter how, walks, hits, whatever. Second, get guys who hit for power, because home runs are just way more valuable than singles. And third, find pitchers who stop the other team from hitting home runs. That's it. By focusing on that, he built a monster team with pocket change. And now for our second case study. A guy who is basically the living, breathing version of this entire explainer, John W. Henry. He's a legendary trend-following trader who made a fortune in the markets, and then he used that exact same data-driven philosophy to buy the Boston Red Sox and break an 86-year-old curse. This quote from Henry pretty much sums up this whole thing. He's saying that whether you're trading stocks or managing a baseball team, we're all just full of beliefs and biases. But data? Well, data doesn't have an opinion. If you can just push your ego and your gut feelings to the side and follow the numbers, you have an almost unfair advantage. You see, when Henry first started out, all the critics called him reckless. They called him the Dave Kingman of trading. Kingman was a player famous for either hitting a home run or striking out, nothing in between. But just look at the data. Kingman's slugging percentage was pretty mediocre. Babe Ruth's was astronomical. The critics had it all wrong. Henry's performance wasn't just a coin flip, it was truly Ruthian. The numbers don't lie. So what's the big lesson from John Henry's story? It's that his success came from this deep, unshakable confidence in his data-driven method. He knew he was going to have losing streaks. Those are the strikeouts. But because his strategy was built on evidence, not on emotion, he knew that if he just kept at it, kept swinging, the home runs would come. And they'd more than make up for all the misses. And this all leads us to our dramatic climax, a single moment in time where everything we've been talking about, tradition, gut feelings, cold hard data, it all comes crashing together on the biggest stage imaginable, Game 7 of the 2003 American League Championship Series. Okay, picture this. The Red Sox ace, Pedro Martinez, is on the mound, and he is pitching the game of his life. But he's just thrown his 100th pitch. That's a critical number. All the data says pitchers start to lose it around then. The numbers are screaming, take him out. But the manager, Grady Little, he goes with his gut. He trusts the look in his ace's eye. He sends him back out there, and the Yankees immediately pounce, costing the Red Sox the game and the World Series. And this one number, is the smoking gun, .370. That was the batting average against Pedro Martinez after he threw 105 pitches that season. A .370 average. That means hitters basically turned into superstars against him once he got tired. The data couldn't have been clearer, but it was ignored for a feeling. So why do we do this? Why do we trust our gut over proven data? The great Stephen Jay Gould explained it perfectly. We believe in things like the hot hand in basketball or streaks in baseball. We think that a pitcher who's dominating will just keep dominating. But the stats have proven over and over again that this is a myth. The odds don't care about our feelings. Okay, let's bring this all home. We've seen how this all plays out in baseball, how it works in finance. So what does this home run mindset actually look like in the real world? How can we start applying it to our own lives? It really just comes down to these three things. First, you have to actively look for those opportunities with huge, massive upside, the home runs. Second, you gotta base your decisions on stuff you can actually measure and prove, not just on feelings or how it's always been done. And third, and this is probably the hardest one, you have to build up the mental toughness to handle the setbacks, to understand that the strikeouts aren't just possible, they're a required part of the game. And that really leaves us with one last question to think about. In your own life, in your career, your investments, your personal goals, where are you playing it safe? Where are you just trying to hit singles when deep down you know you should be swinging for the fences? It's a big question, and, the answer might just change your entire game.
We all have this idea that to win in the markets, you've got to be some kind of genius, right? That you need a secret formula or maybe a fancy degree from an Ivy League school. But what if I told you the real key to success has almost nothing to do with how smart you are? What if it's all about mastering that one thing that trips all of us up, our own human nature? So that's exactly what we're going to unpack here, why psychology, not genius, is what really rules the markets. Now get a load of this quote from Jerry Parker, who is an incredibly successful trader. He says his system requires zero intellectual capability. I mean, think about that for a second. That just completely flips the whole idea of smart money on its head, doesn't it? What he's really saying is that success comes from having a solid system, a system that protects you from your own flawed thinking, your built-in biases, and all those emotional roller coasters.
All right, so here's our game plan. We're going to kick things off by looking at the basic human glitches that mess with our decisions. Then we'll dive right into the specific psychological traps our own brains set for us. We're going to dissect what a losing trader looks like, and then we'll flip it and talk about the solution, building up your emotional intelligence and literally training your brain to win. And we'll wrap it all up by seeing why pure, raw commitment can absolutely crush a fancy degree any day of the week.
So let's start with the big picture. For the longest time, classical economics was built on this really neat but totally wrong idea that humans are rational. But come on, anyone who's actually been in the markets knows that's just not how it works. The reality? Markets are a chaotic swirl of greed, hope, fear, and denial, all that messy, unpredictable human stuff. And this is where we get into something a guy named Charles Faulkner calls cognitive illusions. It turns out our brains are basically hardwired to make the same mistakes over and over again. We love a good story, so much so that we'll pick a complicated, exciting narrative that doesn't work over a simple truth that does. And this leads to one of our biggest flaws. We look back at a chart from 6 months ago and think, oh, of course, it was so obvious. That's not foresight, my friends. That's hindsight.
So how do these little illusions actually show up in the real world? Well, they become these specific, deeply ingrained biases. These are the mental shortcuts that our brains take, and they're the exact same ones that have been leading people into financial disaster for centuries. I'm talking about everything from the tulip mania back in the 1600s all the way to the dot-com bubble. These aren't just bad habits, they're literally part of our operating system.
At the core of all this is something called prospect theory. And the guy behind it, Daniel Kahneman, he actually won a Nobel Prize for this stuff. He discovered we operate on what he called the law of small numbers. Here's what that means. Say a fund manager has a great 3-year run. We immediately convince ourselves he's a genius, a superstar, but statistically, 3 years is nothing. It's a tiny sample. We jump to huge conclusions based on very little data because it gives us this illusion that we have some control in a world that's mostly random. And this is where it gets really interesting. This is how it messes with our actual behavior. Prospect theory uncovered this powerful little quirk called loss aversion. Basically, the pain of losing $1 hurts way more than the pleasure of gaining $1 feels good. This leads to 2 classic, totally irrational mistakes. When we have a winning stock, we sell it way too early because we're desperate to lock in that small win. But when we have a losing stock, we hold on for dear life, just praying it comes back, all to avoid that gut punch feeling of admitting we made a mistake.
Let me ask you something. Let's try a little thought experiment from Kahneman's research to really see this in action. Picture this. You paid $10 for a theater ticket. You get to the front door, you're all excited, you reach in your pocket, and it's gone. You lost it. So the question is, do you pull out another $10 to buy a new ticket? Just think about it for a second. What would you do?
Okay, ready for part 2? Now imagine a slightly different scenario. This time, you were planning to buy the ticket at the box office. But on your way there, you realize a $10 bill fell out of your wallet. It's just gone. The ticket costs $10. Do you still buy it? Now logically, both situations are identical, right? Either way, you're out $10 and you have to decide if seeing the show is worth another $10.
Well, the results are kind of crazy, and they show just how irrational we really are. Check this out. In the first scenario, when the ticket was lost, less than half the people, only 46%, said they would buy another one. It's because in their minds, the cost of that one play just shot up to $20. But when they just lost the cash, a whopping 88% of people went ahead and bought the ticket anyway. They mentally separated the lost money from the ticket purchase. That, right there, is the sunk cost fallacy, and it completely clouds our judgment every single day. So now that we've got the why down, let's look at the what. How do all these biases actually show up in the wild? Well, they create a very predictable and very destructive set of behaviors. If you want to know what failure in the market looks like, these traits right here are its DNA. First up, the big one, greed. And look, we're not just talking about wanting to make money. This is about the desire for the quick buck, the easy score. It's that burning desire to perfectly time the market, to buy at the absolute bottom and sell at the absolute top. This kind of thinking completely blinds people to the fact that real, consistent winning takes a ton of hard work and a disciplined process. It's not about one lucky shot. Next is impatience. You know, real successful trading can be, well, kind of boring. A lot of it is just waiting for the right setup. But so many people have this insatiable need for action. They're chasing that adrenaline rush, that gambler's high. And that addiction to action completely steamrolls the patience and objectivity you absolutely need to make good decisions.
And then there's just a plain old lack of discipline. And let's be honest, it's human nature, right? It is so much easier to just listen to some hot tip you heard on TV than to actually do the hard work of educating yourself, building a system, and learning for yourself. That dependency is a one-way ticket to failure. And finally, we have impulsiveness. We've all seen this. The trader who reads a news headline and bam, they're jumping into a trade, convinced they've got some kind of edge. But here's the hard truth. By the time you're reading about it in the news, it's already in the price. The big money has already moved. Thinking you can beat them to the punch is just a fantastic way to lose your money.
Okay, so if these behaviors are so common and so destructive, what's the answer? Is there any hope? Yes, and this is where we make the pivot. The solution isn't some fancier algorithm or a more complicated chart. The solution is internal. It's all about developing better self-awareness and mastering your own emotions.
The psychologist Daniel Goleman absolutely nailed it with this. He found that the most successful people in any field aren't just driven by external rewards, like a big paycheck. They have this internal fire, this deep, embedded desire to achieve just for the sake of achieving. That internal motivation is the fuel for the discipline it takes to master both the markets and, more importantly, yourself.
And this all ties into this core concept of emotional intelligence. Goleman's big discovery was that things like self-awareness, discipline, and being able to manage your emotions are often way more important for success than just having a high IQ. Now, this isn't about becoming a robot and repressing your feelings. No way. It's about acknowledging your fear or your greed, understanding where it's coming from, and then making a rational decision anyway. It's about managing your feelings so they don't manage you.
Now, the best part about all of this is that emotional intelligence isn't some magic trait you're just born with. It is a skill. It's like a muscle, and that means you can train it. So let's look at some actual practical tools you can use to develop that mental edge that the pros have.
One really powerful tool is called Neuro-Linguistic Programming, or NLP for short. The way Charles Faulkner explains it is simple. Think of your thoughts, your feelings, and your actions as software programs running in your brain. And if you've got a buggy program that's causing you to crash, well, you can debug it. You can upgrade your own mental software for better performance.
So here's a super simple, practical technique from Faulkner that you can literally do right now. First, think about a bad trade you made, a really painful one. Let yourself feel that negative emotion bubble up. Okay, now take a really deep breath in, and as you exhale, just let out an audible ah sound. As you do that, physically imagine yourself pushing that negative feeling out and away from you. Mentally step away from it. It sounds almost too simple to work, but it's an incredibly powerful way to hit the reset button on your emotional state and get back in control.
All right, so as we start to bring this all home, let's bust one final huge myth. The idea that you need some prestigious degree or a fancy background to make it. The truth is, the market does not care about your resume. It doesn't care where you went to school. All it cares about is your mindset and your commitment.
I mean, just look at this incredible contrast. On one side, you have the legendary trader William Eckhart saying he hasn't seen much of a link between raw intelligence and good trading. It's the emotional makeup that matters. And on the other side, you have Alan Greenberg, the former CEO of Bear Stearns, who famously said he didn't want MBAs. He wanted people with what he called a PSD degree. Poor, smart, and a deep desire to be rich. It's all about the hunger, that drive, that passion. That's what wins, not the piece of paper on the wall.
Because when it comes right down to it, the market is a giant, relentless, and unforgiving mirror. It doesn't reflect what you wish was true. It doesn't reflect what you think you know. It reflects your discipline, your patience, your fears, your greed. It reflects you, right back at you. So the ultimate question isn't whether you can predict the market. The real question is whether you can understand yourself. When you look into that mirror, what's it going to reflect about you?
Have you ever felt just completely stuck? You're facing a huge decision. There's a mountain of information staring back at you, and you have no idea which way to go. You're not alone. In a world that just bombards us with data and opinions 24/7, making a clear choice can feel next to impossible. So today, we're going to talk about how to cut through all that noise and build a really solid framework for making better decisions.
So here's the game plan. First, we're going to talk about the information overload trap, something I think we all fall into. Then we'll look at the surprising power of keeping things simple.
After that, we'll get really practical with something called fast and frugal heuristics. Then we'll dive into why you have to focus on your process, not just the result. And finally, we'll put it all together and talk about how to execute without that crippling hesitation.
Okay, let's kick things off with a huge mistake that so many of us make. It's this belief we have, deep down, that if we just gather a little bit more information, our decision will be better. Well, we're about to see why that's not just wrong, it can actually be a dangerous illusion.
You know, this line from Alice in Wonderland just hits the nail on the head, doesn't it? It perfectly captures what it feels like to be alive right now. We've got endless options, endless data points. But without a clear goal, all that information doesn't help. It actually just makes us feel more and more lost.
And this is what that leads to, a vicious circle. I mean, just picture a trader who's glued to the financial news. One expert says the market's going up, the next says it's about to crash. The result? They're so overwhelmed by all the conflicting noise that they just freeze. It's analysis paralysis. They end up doing nothing, and the opportunity is gone.
The researcher Terence O'Dean had this amazing example to really drive the point home. Imagine you had the data from the last 10,000 spins on a roulette wheel. That is a ton of information, right? But does any of it tell you where that little ball is going to land on the very next spin? No way. When you're dealing with something random, all that historical data is basically useless for predicting the future.
And here's the real kicker. The legendary trader Ed Seykota pointed out that even when you think you finally found the perfect reason to make a move, you're probably too late. By the time the story is clear and all the data lines up beautifully, the big opportunity has already come and gone.
So if just piling on more and more data isn't the answer, then what is? Well, now we're going to look at a solution that feels kind of counterintuitive, but it is incredibly effective. It's about cutting through the noise by embracing simplicity. And listen, this is not some brand new idea. We're talking about ancient wisdom here. Thousands of years ago, Aristotle figured this out. He saw that in nature, the most effective solutions are almost always the simplest ones. We're really just rediscovering that idea and learning how to apply it to our own crazy, complex world.
In science, they actually have a formal name for this, Occam's razor. All it really says is that when you're looking at a bunch of different explanations for something, don't make it more complicated than it needs to be. The simplest answer is usually the right one. It's like a tool for shaving away all the extra complexity so you can see what actually matters.
Okay, so taking that idea of simplicity and actually putting it to use, well, that leads us straight to heuristics. Now, it sounds like a complicated word, but a heuristic is just a fancy term for a mental shortcut, a rule of thumb. It's your brain's secret weapon for making good, fast decisions by deliberately ignoring most of the information out there.
So let's see how these little shortcuts work in the real world. We're going to dive into what experts call fast and frugal heuristics and see how these dead simple rules can actually beat out super complex analysis, especially when the pressure is on and you don't have time to think.
I absolutely love this analogy from the cognitive scientist Gerd Gigerenzer. Think about an outfielder trying to catch a fly ball. Do you really think they're out there solving differential equations in their head about wind speed and trajectory? Of course not. They use a simple heuristic. Just run in a way that keeps the angle between your eye and the ball the same. That one simple rule solves an incredibly complex physics problem in real time. It's brilliant.
And you can hear it straight from a pro. The former catcher Tim McCarver talked about the insane pressure of calling a pitch. His advice? You just have to put down a sign and do it fast. Trust your training and go with your gut. He's saying that overthinking, that second guessing, that's where you make mistakes.
Now, this is the really important part. This logic doesn't just apply on a baseball field. It applies perfectly on the trading floor. The environment might look totally different, but the core challenge, it's exactly the same. You have to make a high-stakes call under pressure with incomplete information. And in both arenas, fast, simple rules win.
I mean, look no further than John W. Henry. The guy is a legendary trader who also happens to own the Boston Red Sox. He was totally open about it. He said, "I can't be an expert in everything." His edge wasn't more knowledge, his edge was speed. His simple heuristic was just price information. That's it. By focusing only on price, he could cut through all the noise, act fast, and create his opportunities.
This brings us to what might be the single biggest mindset shift we're going to talk about. You have to learn how to judge the quality of your decision-making process completely separately from how things turn out in the end. They are two different things.
So let me just ask you a tough question. If you make a really risky bet, something you probably shouldn't have done, but you get lucky and it pays off, was that a good decision?
It's so easy to say yes, but confusing a good outcome with a good decision is a path to absolute disaster.
This chart here just lays it out perfectly. In the top right, you've got a good process that leads to a good outcome. That's deserved success. Great. Top left, you've got a good process but a bad outcome. That's just a bad break. You got unlucky, but you shouldn't change a thing. Bottom right, bad process, bad outcome. We call that poetic justice. But the most dangerous place to be by far is that bottom left quadrant, dumb luck. That's where a bad process accidentally leads to a good outcome. And the trader Larry Hite explains exactly why that's so dangerous. He says winning on a bad bet is the worst thing that can happen to you. Why? Because it reinforces all your bad habits. It teaches you the wrong lesson. You start thinking your flawed method is brilliant, so you keep making more bad bets until, inevitably, your luck runs out.
All right, so we've got our simple rule, our heuristic, and we've got our mindset straight. Focus on the process. So what's the final piece of the puzzle? What's the thing that turns a good decision into a successful action?
The author Clayton Christensen drew this incredible distinction. On one side, you have theory-free investors. These are the folks who just react to what's already happened. They wait for all the data, they follow the crowd, and they're always a step behind. But on the other side, you've got theory-driven decision-makers. They have a system, they have a framework, and they act before the trend is obvious to everybody else.
And the perfect way to think about this is the mindset of a pitcher. The coach calls the pitch. That decision is made by the system. The pitcher's job isn't to stand there on the mound and debate the call. No, their one and only job is to trust that system and focus 100% of their energy on executing that one pitch flawlessly. That's it. That's the mindset.
And, this famous quote from Einstein really wraps it all up. The point isn't to be naive or too simple. The real genius is in taking all that complexity and distilling it down to its simple, powerful core. The goal is to find the simplest rule that actually works, and then have the discipline to trust it.
So, I'll leave you with one final question to think about. In this incredibly complex, noisy world, what's your one simple rule? What is the one fast and frugal heuristic that you can develop and really truly trust to help you cut through the static and act with confidence?
So, what's the real difference between a trader who's consistently profitable and, well, a gambler? It's not about luck. It's not about some secret formula. Today, we're going to deconstruct the mindset of a successful trader, and you'll see it's less about magic and more about a rigorous science, a discipline that's grounded in numbers, models, and a really deep understanding of reality. This quote from Andrian about her husband, the great Carl Sagan, it's everything. This is the foundation for our entire explainer today. It's all about that massive shift in mindset, getting away from hope, from belief, from gut feelings, and instead just relentlessly chasing knowledge, evidence, and the things you can actually prove. So, here's our game plan. First, we're going to define what a science of trading even looks like. Then we'll get into the main tool for any scientist, asking the right questions. After that, we'll dive into why you absolutely have to think in probabilities, how to look past the flawed bell curve model that finance loves, and finally, how all of this unlocks the incredible power of compounding. All right, let's jump right in. What does it really mean to look at the wild, chaotic world of trading through the methodical, disciplined eyes of a physicist? It means you start to see the market for what it actually is, a super complex system, just like the physical world. It's a system with its own laws and properties, driven by forces you can actually observe, measure, and even model. So the goal isn't to guess what's going to happen next. No way. The goal is to build a model that describes how things work, and then, and this is key, constantly test that model against real-world data. And this is the crucial point. This quote from the legendary trader Ed Seykota just nails it. Successful trading isn't about having a feeling that a stock is going to go up. It's about defining your risk, measuring your performance, and managing your entire system based on cold, hard data. Because what you measure, you can improve. If you don't measure it, you're just playing a game of chance. Okay, so we've got that scientific mindset locked in. Now we need the right tool to actually put it to work. And believe it or not, it's not some crazy complex algorithm or a secret black box. It's something way more fundamental. It's the power of asking the right questions. The real skill here is learning to ask smart, critical questions. And we're not talking about simple stuff. We're talking about questions that dig deep to find the real problem, questions that force us to see our own hidden biases. They're designed to make us look at the facts, no matter how uncomfortable, and to follow the evidence wherever it takes us, even if we don't like the destination. This is how a true scientist, or a great trader, tackles a problem. This right here shows the huge gap between two ways of thinking. On one side, you've got the rote learner, the kind of investor who just asks, hey, what's the hot stock tip? They just passively accept whatever they're told. But on the other side, you have the critical thinker. They're asking, why is this true? Show me the evidence. This is the huge difference between just taking what Wall Street gives you and actively owning your understanding of the market. You know, this ancient wisdom just perfectly captures the whole philosophy. It's not about believing rumors or following some guru on social media. It's about observation, analysis, and reason. Real, actionable knowledge doesn't come from being told something. It comes from what you can see for yourself and verify through your own rigorous testing. Okay, so now we have the scientific mindset, and we have our tool, critical questioning. Let's start applying them to the market itself. Because we have to understand the real environment we're playing in. And spoiler alert, it is not what most people think it is. And that environment really is defined by chaos theory. The market is not some neat linear machine where A always causes B. Nope. It's fundamentally non-linear. Cause and effect can get really blurry, and those wild, unexpected events, they're not bugs in the system, they're a core feature. A scientific trader doesn't try to predict the chaos. They build a system that's designed to navigate it. And that's why statistical thinking is so vital. The great mathematician Laplace knew this hundreds of years ago. We can't know the future with 100% certainty, but we can understand the probabilities. So let's use a really simple but powerful analogy to see exactly why thinking in probabilities will always beat trying to make a perfect prediction. Now, just take a second and think about this. You've got two hospitals. We all know the long-term average for boys and girls is pretty close to 50-50, but on one particular day, one hospital has this huge statistical outlier. So is that extreme result more likely to happen in the small hospital or the big one? The answer, of course, is the small hospital. This is a perfect example of the law of large numbers. A small sample size allows for these huge random swings away from the real average. The bigger hospital with 120 births, its results are almost always going to be clustered much closer to that true 50-50 line. And this is brilliant because it shows why this concept is so incredibly important for traders. Your buddy who got lucky on one stock tip, that's the small hospital. It's a totally meaningless sample size. A trading system with 10 losses in a row might look like a total failure, but if you've only seen 10 trades, you've learned absolutely nothing. It's only over a huge sample size, hundreds, even thousands of trades, that the true probabilistic edge of a system can finally show itself. So this deep understanding of stats and probability gives scientific traders a massive edge. We're going to talk specifically about trend followers. These are traders who build systems to profit from big, long-term market trends. And their edge comes from seeing the world and market returns in a totally different way than conventional finance does. Wall Street is absolutely obsessed with the bell curve, also called the normal distribution. I mean, you can see why. It's neat, it's tidy, it's symmetrical. It suggests this predictable world where most things are just kind of average, and huge market crashes or massive rallies are like once-in-a-lifetime events. Their entire idea of risk is built on this assumption. But what if the world isn't normal? And that brings us to this idea of skewness. See, a trend follower's returns aren't symmetrical at all. They're positively skewed. What that means is their system is built to have lots of small, manageable losses, but also to catch these massive winning trades that are way bigger than any of the losses. It's a strategy that's literally designed for big, positive surprises. So when you mix that positive skew with something called high kurtosis, you get what's known as fat tails. And that just means that extreme events, like the market crashes in '87 or 2008, or huge bull markets, they happen way more often than the neat little bell curve says they should. Scientific traders don't see these as rare events. They see them as a regular part of the market, and their systems are built to take advantage of them. And this right here is the ultimate payoff for this entire approach. When you ask the right questions, you think in probabilities, and you understand the true statistical nature of the markets. You can survive the chaos that you know is coming, and you unlock the single most powerful force in all of finance. As the famous investor Jim Rogers says, the real trick is to not lose a catastrophic amount of money. It's the big losses that just kill your ability to compound your wealth. By having a system with that positive skew we talked about, where your losses are always cut short, you protect your capital. And that lets the magic of compounding really go to work over time. Just look at how dramatic this can be. The math here is staggering. That initial $20,000 account, if it earns 50% a year, grows to over $600,000 in just 7 years. Even at the lower rates, the exponential growth is just undeniable. This isn't some get-rich-quick scheme. It's the simple, powerful math of generating consistent returns and just reinvesting those profits year after year after year. And if you think this is just some fantasy on a spreadsheet, check this out. The real-world compounded returns from a scientific trend-following fund, like David Harding's Winton Fund, have historically outperformed the returns of one of the most famous art investments in history, Van Gogh's irises. A disciplined, scientific process can create more wealth over time than a legendary, one-of-a-kind physical asset. Think about that. So what's the one big takeaway from all of this? It's captured perfectly in this quote. Stop trying to find equilibrium. Stop trying to predict the future. The markets are always in a state of change. The only way to survive and to succeed is to build a strong system that can adapt to reality as it happens. Because in the chaotic, nonlinear world of the markets, prediction is a fool's game. But adaptation, that is the science of survival. Let's be honest, have you ever wished there was just one secret? A simple formula for getting rich? A single key to unlock the whole market? Of course you have. We all have. And that desire, well, that's the foundation of every story Wall Street loves to sell. So today, we're going to pull back the curtain on these financial holy grails and see what's really going on behind the scenes. Wow. Okay, that's a quote from the legendary trader Jesse Livermore, and it sets a pretty blunt tone, doesn't it? For more than a century, people in the know have seen Wall Street not as your partner, but as a place that cashes in on your hopes. It's a provocative way to start, for sure, but it gives us the kind of healthy skepticism we're going to need. And this is the classic setup, right? On one side, you've got these huge, confident promises. Dow 36,000 is coming. They paint a picture of endless growth. But on the other side, you've got the cold, hard reality. The dot-com bust, the 2008 crash, disasters that just vaporized people's life savings. That huge gap between the promise and the reality, that's where investors get absolutely crushed. So here's our game plan for today. First, we're going to dig into why we're so desperate for these easy answers to begin with. Then, we're going to start demolishing the biggest myths, one by one. We'll hit the buy and hold myth, decode the Warren Buffett legend, expose the trap of averaging down, and even look at why the so-called experts can lead you astray. And then, at the end, we'll talk about the one strategy that actually works. Okay, first up, let's talk about our own brains. The market is just chaos, right? It's messy, it's complex, it can be really frustrating. And when we're faced with all that complexity, our brains just want a shortcut. We crave a simple rule of thumb to make us feel safe. The problem is that rule can turn into a dangerous security blanket, blinding you to what's really happening in the market. So when we say an investing holy grail, what are we actually talking about? Well, it's any system, any secret formula that promises to make the complexity of the market simple. It's the idea that you can get rich without all the hard work of actually thinking for yourself. It's a really, really seductive promise. But as we're about to see, it's almost always a false one. All right, let's tackle the big one, the most popular holy grail of them all, buy and hold. I mean, you've heard this a million times from every financial advisor out there. Just stay the course, they say. Don't panic. But what if the course is leading you straight off a financial cliff? This quote from trader Tom Basso just nails it. It gets right to the emotional gut punch of buy and hold during a crash. I mean, really ask yourself, could you watch half of your retirement account disappear and just sit there and do nothing? For most human beings, the psychological pain of that is just way too much to handle. And this leads us to the real question, doesn't it? Is buy and hold really a strategy at all, or is it something else? A lot of people call it buy and hope, and that's a huge difference. See, a strategy is an active plan to manage your money, and even more importantly, to manage your risk. Hope is just, well, it's closing your eyes, crossing your fingers, and wishing for the best. And if you want to see this danger in the real world, just look at the NASDAQ back in the 70s. It peaked in late 1972, and then it just fell off a cliff, crashing nearly 60%. If you were a buy and hold investor, you wouldn't have even gotten back to even until April of 1980. Think about that. That's almost 8 years of your life with zero returns. You would have literally been better off stuffing your cash under a mattress.
And if you think that's just a one-off, think again. Let's look at Japan. Their main stock index, the Nikkei, peaked near 40,000 way back in 1989. 19 years later, it was still stuck below 10,000. This is the absolute nightmare scenario for buy and hold, because it proves the one thing nobody wants to admit. Markets don't always come back. At least not in a time frame that matters to you.
And that's just for a whole market index. For an individual stock, it can be so much worse. Take a company called University Computing. Back in 1968, it was the hottest tech stock around. By 1970, just 2 years later, it had lost 93% of its value. It was basically wiped out. Buying and holding that wasn't a strategy. It was a one-way ticket to financial ruin.
Now, I know what you're thinking. Anytime someone criticizes buy and hold, one name comes up. But what about Warren Buffett? He's always held up as the shining example, the ultimate proof that it works. But is the public image of Warren Buffett the whole story? Is he really just this simple, folksy guy buying stocks he likes? Let's dig a little deeper. Okay, check this out. In May of 2002, Buffett and his partner Charlie Munger were publicly bashing derivatives. I mean, Munger called the accounting for them an insult to sewage, and Buffett himself famously called them financial weapons of mass destruction. So their position was crystal clear. These things are terrible. But then, get this, just 16 days later, Warren Buffett announces that his company worked with Goldman Sachs to create a brand new complex derivative security, the very same kind of financial weapon he had just warned the world about. Now, the point here isn't to knock Buffett. The point is that the legend is more complicated. He's not just a passive idealist. He's an incredibly active and sophisticated operator.
Okay, let's move on to the next holy grail, the idea of averaging down. The logic sounds so smart, doesn't it? Hey, if I liked this stock at $50, I should absolutely love it at $40. So you buy more as the price keeps falling. But this is a strategy that can make you feel confident right up until the moment you go broke. The legendary trader Paul Tudor Jones famously had a sign on his wall that said simply, "Losers average losers." It's so blunt but so true. Winning investors don't add to their losing positions, they cut them loose. Constantly adding more money to a bad bet isn't an investment strategy, it's a gambler's bad habit. And we have a perfect and tragic real-world example of this. Remember Enron? The massive company that just imploded into scandal? Well, a huge investment firm called Alliance Capital Management admitted they owned a ton of Enron. And you know what they did as the stock was collapsing towards zero? In their own words, they bought it all the way down. They kept averaging their loser until there was nothing left. Jesse Livermore explained the psychology of this trap perfectly, almost a century ago. It goes like this. You buy 100 shares at $50. It drops to $47. Instead of admitting you might be wrong, your ego kicks in and tells you to buy another 100 shares to lower your average cost. But now, when the price hits $44, you have doubled the position and double the worry. And as Livermore warned, you just keep doing that until you run out of money. So at this point, you're probably thinking, okay, if all these common strategies are flawed, I'll just listen to the experts, right? The analysts on TV, the big Wall Street firms, they must have the answers. Well, if you look at the data, you'll see that relying on them can be one of the biggest mistakes you can make. Just look at this. It's staggering. This is from the year 2000, right at the absolute peak of the dot-com bubble. Out of over 28,000 recommendations from Wall Street analysts, 99.1% were either strong buy, or hold. Less than 1% advised selling anything. This wasn't analysis. This was a herd mentality, and they were leading investors right off a cliff. And here's the result. These are real quotes from everyday investors who followed that advice. You can feel the frustration and the anger, right? That sense of total betrayal. They put their trust in these experts, and they were left holding portfolios full of worthless stocks, all while no one bothered to warn them that the whole thing was a mirage. So, after tearing down all these myths, it's pretty easy to feel cynical about the whole thing. I got it, but the goal here isn't to leave you feeling hopeless. It's the exact opposite. The goal is to clear away all that bad advice to make room for a mindset that actually works. A mindset built on empowerment and taking personal responsibility. So, let's just boil it all down. Stock tips are basically useless because they only tell you when to buy, never when to sell. Just finding value isn't a complete strategy on its own. And that old dream of just buying and holding your way into a comfortable retirement, yeah, that's pretty much toast. And all of this leads to the single most important lesson. Your financial future is your responsibility because nobody else is going to protect it for you. We've seen that the easy answers, all these holy grails that Wall Street sells you, are just illusions. They're designed to distract you, to keep you from what really matters. So the final question isn't for me to answer. It's for you. Now that you know the myths are gone, how are you going to take control? Welcome back to The Explainer. Today, we are diving deep into what really separates professional traders from everyone else. We're going to explore how they build systematic, rules-based approaches to the market to get rid of the two things that absolutely sabotage most people: emotion and guesswork. So let's kick things off with this powerful idea from Erica Jong. Risk is, of course, the name of the game in the markets. But, as we're about to see, not all risk is created equal. In fact, sometimes trying to play it too safe, well, that can be the biggest gamble of all. So you gotta ask yourself, is successful trading really about predicting the future? About knowing exactly what's gonna happen tomorrow? Well, if you ask the pros, they'll tell you absolutely not. No way. They're not in the business of forecasting. Instead, they rely on something way more powerful: a repeatable, defined process. Okay, section 1, risk, reward, and rules. To even understand that process, we first have to completely reframe how we think about risk. We're not talking about a pointless gamble here. We're talking about taking a calculated, almost business-like approach to putting your money to work. And this is the crucial distinction right here. On one side, you've got blind risk. That's the emotional, hope-based gamble. It's the sucker play. On the other side, you've got calculated risk. This is logical, methodical. It's how fortunes are actually built. Trend followers, the pros we're talking about, they live exclusively on this side of the line. They don't guess, they calculate. This quote just highlights that central paradox perfectly. You know, conventional wisdom tells us to avoid risk at all costs, but successful traders understand that if you refuse to take a calculated risk, you're also refusing the opportunity for reward. Sometimes the riskiest thing you can possibly do is stand still. So how do they manage that risk? Well, it's not with gut feelings or hot tips or what they heard on the news this morning. Nope, they use a trading system. The best way to think about this is like a detailed business plan for your money. Every single decision is governed by a pre-written set of rules. It takes a chaotic activity and turns it into a disciplined, repeatable process. So how do you actually build one of these things? It sounds complex, I know, but it really all boils down to creating clear, straightforward answers to 5 fundamental questions. And here they are. These 5 questions right here are the complete blueprint. What market? How much? When do I get in? When do I get out if I'm wrong? And when do I get out if I'm right? I mean, if you can answer each one with a specific rule, you have a complete trading system. This framework covers every single decision you need to make. No more guesswork. All right, let's break this down, starting with those first 2 questions. Think of these as the big strategic decisions you make before you ever even think about clicking the buy button. They really set the stage for everything that comes after. Question 1, what market do I trade? For most trend followers, the answer is, well, as many as possible. Just take a look at the portfolio of the AHL fund, one of the biggest trend followers in the world. They're in everything: currencies, bonds, energies, stocks, you name it. Why? It's simple, really. They have no idea which market is going to produce the next massive trend, so they spread their bets out as widely as possible to make sure they're there when it happens. And this quote right here perfectly captures the logic behind question 2, how much? This is not about picking a random number of shares. It's about creating a control system for risk. I love this analogy. It's like a thermostat that prevents your portfolio from ever getting too hot and burning you. And a very common rule for that thermostat is to risk only a tiny fraction of your total capital on any single trade. A lot of pros use a figure like 1 or 2%. This simple rule ensures that no single loss, or even a whole string of losses, can ever knock you out of the game. It is all about survival. It's about capital preservation. All right, now for the tactical side of things. We've covered what to trade and how much. So now let's look at the dynamic rules of engagement. Those final 3 questions that tell you exactly what to do once you're actually in a trade. Question 3. When do you buy? The answer here is deeply counterintuitive for most people. See, trend followers don't try to buy at the bottom. They don't try to buy low. They actually wait for a price to break out, to start moving with real momentum before they jump in. Their goal isn't to be first, it's to be on board once a real trend has proven itself. Question 4 is arguably the most important one of all. When do you get out of a loser? The answer is simple. It's non-negotiable. You get out fast. This is the absolute cornerstone of risk management. You define your maximum acceptable loss before you even get in the trade. And if the market hits that point, you're out. No hesitation, no debating, no hoping. The legendary speculator Bernard Baruch understood this perfectly. He knew that success wasn't about being right all the time. It was about having the discipline to quickly admit when you're wrong and cut that loss before it grows into a complete disaster. And this is how it all comes together mathematically. Now, what's really interesting here is that many successful trend followers are actually wrong more often than they're right. They might lose on 60% of their trades, but it doesn't matter. Because, as you can see, each of those losses is small and strictly controlled, while their winners, well, their winners are massive. A few huge wins can easily pay for all those small losses and then some. This brings us to the 5th and final question. When do you get out of a winner? And the rule here is the exact opposite of cutting losses. You don't exit just because you've got a nice profit. No. You stay in that trade and you let it run for as long as the trend continues, trying to capture the biggest part of that move you possibly can. And this story is such a powerful cautionary tale about the danger of breaking that rule. Leo Melamed, a giant in the futures industry, got out of a massive trend in silver because some expert told him it was too expensive. He abandoned his system for an opinion, he took his profit early, and then he had to watch as the market more than tripled after he got out. He left millions on the table because he didn't let his winner run. So let's pull all 5 of these pieces together. When you have rules for what to trade, how much to trade, and the 3 wins, what have you actually created? Well, you've created a machine for disciplined execution. See, the beauty of a system is that you design your entire strategy when you are calm, objective, and rational. You hardwire all your decisions in advance, so when the markets get volatile and stressful, you don't have to think, you don't have to feel, you just have to follow the plan. Your system already has all the answers. This quote from a legendary trader, Larry Hite, just captures the entire philosophy perfectly. It's not an offensive game focused on profits. It's a defensive game focused on risk. By asking, how much can I lose first, you guarantee you'll stay in the game long enough for those big, winning trends to eventually find you. And that leaves us with this one last question to think about. As you look at the markets, are you trying to predict what's going to happen next, like some kind of fortune teller? Or are you building a robust, repeatable system based on rules and discipline, one that's designed to thrive in a future that absolutely no one can predict?
All right, let's just jump right in. Most of us are taught to think about the financial markets as a place for investing, right? You know, this serious, stuffy, long-term thing. But what if that's completely the wrong frame? What if it's not about investing at all? What if it's really a giant, high-stakes, global competition? What if it's just a game?
You know, this quote from Alexander Einachin is just brilliant because it boils everything down to 3 simple rules. First, you've got the players who know they're sitting at the table. They know the rules, they know they're playing to win. Then you have the folks who are at the table, but they don't even realize a game is being played around them. And then there's that third group, the really scary one. The players who are so completely unaware that they've stopped being players at all. They have become the game. They are the chips being played.
And this leads us to that old poker saying that is just so true in the markets. If you sit down at a poker game and you look around the table and you can't figure out who the sucker is, well, I've got some bad news for you. It's you. So as we go through all of this, you got to ask yourself that one tough question. Who's the patsy in your world? Okay, so if it's a game with winners and losers, it probably makes sense to study how the winners actually play, right? So let's pull back the curtain on one specific type of player who, more often than not, comes out on top: the trend follower. And let me tell you, their playbook is a whole different ballgame from what most of us been taught.
And this right here just lays it all out. On one side, you have the average investor. They've been told to buy and hold, no matter what. They only bet on prices going up. They are glued to the news, their decisions are driven by fear and greed, and they are obsessed, absolutely obsessed with being right about their picks. But the trend follower, totally different. They just react to what the price is doing. They'll trade markets that are going up and down. And they're not driven by some news headline or a gut feeling, they're driven by a system. See, their goal isn't to be right, it's just to win.
The legendary trader Larry Hite just nails this mindset. The story goes that a friend asked him if his trading, which was all based on a mechanical system, was, boring. And his answer gets right to the heart of this philosophy. This isn't about getting a thrill. It's not about the adrenaline rush of a hot stock tip. It is a calculated, unemotional, and yeah, maybe sometimes it is a little boring, but it's all in the pursuit of one thing: winning the game.
So you're probably thinking, okay, if this works so well, why doesn't everybody just do it? Well, here's the crazy part. The whole strategy actually works because of how the majority of people behave. For trend following to stop being effective, the entire herd would have to completely change its stripes. They'd have to give up on buy and hold, learn how to bet on prices going down, get out of those mutual funds that their retirement plans force them into, adopt strict risk management, and, this is the big one, completely separate their ego from their money. I mean, come on, is that really going to happen? Not a chance.
Now, whenever you have players who are consistently winning in a game that feels, well, zero-sum, you're going to make some enemies. When most people lose money, they go looking for a villain, and trend followers are a really easy target. So let's step into this blame game and just blow up some of the biggest myths you're going to hear.
Okay, here's the first big one. The accusation is that these traders, with all their systematic selling, are the bad guys who actually cause the market crashes and the worldwide panics. They're painted as the arsonists who start the whole fire.
But the reality? It's so much simpler. Trend followers are trend followers. They're not trend starters. They don't have some magic crystal ball that tells them a crash is coming. They are simply reacting to what the price is already telling them. They see the smoke, and their system tells them to get away from the fire. They're not holding the matches.
This one's a gut punch. It's a purely emotional argument. There's this deep-seated idea that making money while other people are losing it, especially in a big downturn, is just wrong. One critic even called it obscene.
But look, that feeling, that emotional reaction, it completely ignores the basic reality of the game. The market has a public rulebook, and those rules say very clearly you can bet on prices going up, that's going long, or you can bet on prices going down, going short. Blaming a trader for going short is like getting mad at a chess player for using their queen. It's not cheating, it's a fundamental, legal, strategic part of the game.
Oh, this is a classic. You'll hear this one all the time. The idea that what trend followers do isn't real investing. It's looked down on, dismissed as just trading, like that's some kind of dirty word. Let's just be brutally honest for a second. The whole point of the markets is to allow people to trade. That is their primary function. And at the end of the day, the market doesn't care one bit about your philosophy. It doesn't give out trophies for being a noble investor. It simply rewards the winners and takes money from the losers. Period. End of story. And that brings us to maybe the most important part of this whole thing. Look, having a winning system is one thing, but having the mental toughness to actually stick to it day in and day out, that's a whole other universe. This is where the real fight happens. It's an inner game. General Patton wasn't a trader, but man, did he understand winning. Victory isn't decided in the heat of the moment. It's decided long before, through preparation, through discipline, through having a plan that you trust, especially when everything is going crazy. For a trader, that means trusting your system, even and especially when every fiber of your being is screaming at you to do the opposite.
This right here, this data from trend follower Salem Abraham, is where the rubber meets the road. Just look at these numbers. On any single day, his system's win rate was only 54%. That's basically a coin flip. Can you imagine the psychological pressure of being wrong almost half the time? But just watch what happens when you stretch out the clock. Over 3 months, that jumps to 64%. Over a full year, it's 92%. And over any 2-year stretch, it was 100%. This table is the entire inner game.
It's having the discipline to survive the pure randomness of the short term so you can collect the statistical edge in the long term.
Of course, not everyone's a fan. Here's a pretty nasty quote from an academic who worked at big-name firms like AIG and Vanguard. He uses a common industry metric, the Sharpe ratio, to basically argue that these guys are charlatans who are stealing investor money. That's a huge accusation. But the real question is he even using the right tool to measure them?
And here is the fatal flaw in that entire argument. As another great trader, David Harding, explains, the Sharpe ratio is just the wrong tool for this kind of strategy. See, it's designed to penalize volatility, but it's dumb. It can't tell the difference between good volatility, like a giant winning month, and bad volatility. It treats a massive unexpected win as being just as risky as a massive loss. I mean, just think about how insane that is. It literally means you could take your biggest winning trades, erase them from your track record, and your risk-adjusted score would actually go up. It's a completely broken way to measure performance here.
All right, so we've talked about the game, we've talked about the players, the playbook, the psychology, we've busted the myths, and we've taken apart the criticisms. And all of that brings the spotlight right back around to you. Knowing what you know now, what's your move?
Larry Hite again just frames this so perfectly. Every single decision we make in life is a bet. It's a calculation of risk and reward. It doesn't matter if you're deciding to hit on 16 in blackjack or jumping out of the way of a bus. You are constantly, whether you realize it or not, weighing probabilities. The only real question is, are you making those bets consciously, with a plan, with an edge, or are you just closing your eyes and gambling?
Just think back to 2008. The financial crisis was a brutal, brutal lesson for the whole buy and hold crowd. It exposed just how flawed that thinking really was. But at the same time, many trend followers who were playing by a completely different rulebook had one of their best years ever. That whole disaster was a wake-up call. It ripped the mask off and showed everyone the true nature of the game. So the only question left, the one that really matters, is right there on the screen. Will your behavior change now that you know better?
You know, in the world of investing, there's this constant battle between two completely opposite ideas. On one side, you have this belief that prices, no matter how crazy they get, always, eventually, snap back to average. They call that mean reversion. But then you have this other philosophy that says, nope, a trend in motion is probably going to stay in motion. So which one is right? Which one actually makes money in the long run? Well, we're about to find out. And this quote from the legendary trader Jerry Parker just nails it. He basically says that betting on things to get back to normal, that mean reversion, it feels safe. And yeah, it works most of the time, racking up a bunch of small, satisfying wins. But then it stops working. And in that one moment, a single catastrophic loss can wipe out everything. It's the perfect way to describe the hidden danger of trying to stand in front of a freight train. So that leads us to the big question for today. If fighting the trend is so dangerous, what happens if we just join it? Can a simple strategy, just buying what's going up and selling what's going down, actually work on individual stocks over the long haul? To get a real answer, we're not going to guess. We are going to dive deep into a massive academic study that put this exact question to the test. So here's our game plan. First up, we'll lay out these two warring philosophies. Then, we'll go inside the massive 22-year experiment they built to test this. We'll get into the nitty-gritty, the exact rules for getting in and getting out of a trade. Then comes the fun part, what the data actually revealed. We'll uncover the secret sauce that makes it all work. And finally, we'll deliver the final verdict. Okay, first things first, let's really set the stage and make sure we understand these two totally different ways of looking at the market. It really all boils down to a single question. Are you betting on things to change, or are you betting on them to stay the same? All right, so on the left, you've got mean reversion. This is the classic buy low, sell high idea that just feels right, doesn't it? The problem, like we said, is when that stock you bought low just keeps going lower and lower and lower. Ouch. But on the right, you have trend following. This approach doesn't even try to predict where the top or bottom is. It just says, hey, that stock is on fire. Let's jump on for the ride. The goal isn't about being right all the time. It's about being right big when you catch one of those monster trends. But listen, talk is cheap. Anyone can have a theory. To really find out if trend following works, we need proof. We need cold, hard data. And that's exactly what researchers Cole Wilcox and Eric Crittenden set out to find. They built this huge, unbiased experiment to get a definitive answer. Let's see how they did it.
And when I see massive, I mean it. This wasn't some tiny sample size. The study's database had over 24,000 individual stocks from the big 3 U.S. exchanges, the NYSE, AMEX, and NASDAQ. I mean, that's pretty much everything. It's about as comprehensive as you can possibly get.
And the time frame? A whopping 22 years. Now, this is so important because it covers all kinds of markets. We're talking the '87 crash, the dot-com bubble and bust, the huge bull market of the '90s, everything. Any strategy that can survive and thrive through all of that has really proven something.
Now, this slide is absolutely crucial because it shows the researchers weren't playing games. They made this test as realistic as possible. First, they got rid of survivorship bias. What's that? Well, they included all the data for stocks that went bankrupt or got delisted, the losers. That was more than half the database. Next, they adjusted all the prices for things like dividends and stock splits. And finally, they filtered out all the tiny penny stocks you could never actually buy or sell in real life. This wasn't a fantasy, it was a real-world stress test.
Okay, so for a test like this to be legit, the rules have to be 100% mechanical. No gut feelings, no, I think the market looks good today. It has to be black and white. So what were these super simple systematic rules for buying and selling?
The entry rule is, honestly, it's brutally simple. If a stock closes at the highest price it has ever been in its entire history, you buy it. That's it. Now, this goes against every buy-the-dip instinct you've probably ever had. But think about it. By definition, a stock hitting an all-time high is in a powerful uptrend. This rule is designed to get you on board for exactly those moves.
And here is exactly what that looks like in the real world. Take a look at Microsoft on the left. The system flags an entry right as it's breaking out, catching the very beginning of a trend that would make history. Same thing for EMC on the right. Every single one of those little dots is a new all-time high, a signal to just stay put and ride the wave. There's no news, no earnings reports, just pure price action. So, if the entry rule is your offense, the exit rule is 100% your defense. The study used something called a trailing stop, based on a stock's own volatility, which they measured with the average true range, or ATR. Just think of ATR as a way to measure how much a stock typically bounces around each day. And this is the magic part. The stop isn't some fixed number. It automatically gives a crazy tech stock more room to wiggle, but it keeps a really tight leash on a slow, steady utility stock. It's like a smart, custom-fit defense for every single trade.
And here is exactly why that defense is so critical. Look at these charts. Enron, WorldCom, two of the most notorious corporate flameouts in history. If you were a buy and hold investor, you would have written these things all the way to zero. But look what the system does. See that red line? That's the trailing stop. The second that beautiful uptrend broke and things got ugly, the system would have hit the eject button automatically, saving most of the profits and avoiding a complete disaster. This is the rule that keeps you alive to trade another day.
So let's recap. We've got a rock-solid 22-year test, a massive data set of stocks, and dead simple mechanical rules. After running the simulation on over 18,000 trades, what did the data actually say? Let's get to the good stuff. All right, here it is, the top-line results from all 18,000-plus trades. Now, I know there's a lot of numbers on this table, but don't worry. We're going to zoom in on the only two numbers you really need to see to understand everything. The first number that probably catches your eye is the win rate, 49.3%. And I bet your first reaction is, wait, what? That's less than a coin flip. How on earth can you make money losing more often than you win? It feels totally backwards, right? But here's the secret, and you gotta get this. For a trend-following system, the win rate is almost meaningless. It doesn't matter. The real magic, the entire key to the kingdom, is hidden in a completely different number. And here it is, 2.56 to 1. This is the ratio of how big the average winner was compared to the average loser. Let's break it down. The average winning trade made a huge 51.2% gain, but the average losing trade, it was cut short at just a 20% loss. That gives you a ratio of 2.56 to 1. In plain English, for every single dollar you lost on a bad trade, you made, on average, more than $2.50 on a good one. That, my friends, is the mathematical engine that drives profitability. So it all comes down to this relationship, the size of your wins versus the size of your losses. Let's dig in a little deeper and really understand why this win big, lose small dynamic is the absolute secret sauce.
The whole system is built on this really powerful concept called positive asymmetry. It sounds complicated, but it's not. It just means that your losses are deliberately kept small.
They are capped by that trailing stop. But your winners, they have no limit. They are allowed to run as far and as high as the trend will possibly take them. This creates a situation where you have a bunch of small, annoying losses, but they are all paid for and then some by a few rare, absolutely massive wins.
And this chart is the proof that the defense held up. It shows what they called negative outlier trades, basically those really painful losses that were bigger than you'd expect. But look at the numbers. Even during the infamous 1987 crash, these were super rare. And during the dot-com implosion in 2000, it was just 3% of the trades. The defense worked even in the worst market conditions imaginable.
Now contrast those small, managed losses with the explosive upside. This is the fun part. This table shows just a few of the grand slams the system would have hit. I mean, just look at these numbers. It's insane. Cisco hit a new all-time high 488 times on its way to a gain of almost 100,000%. Microsoft over 62,000%. These are those rare, uncapped portfolio-making home runs. You only need to catch one or two of these a decade to make the whole thing work beautifully.
Okay, so we've looked at the philosophy, we've dissected the 22-year test, we understand the rules, and we've seen the results. It's time to bring it all home and answer our original question.
The conclusion from the researchers was about as clear as it gets. Based on 22 years of data, thousands of stocks, and over 18,000 trades, the evidence is just overwhelming. The verdict is in. A simple, purely mechanical system of buying strength and cutting losses ruthlessly is a historically profitable strategy for stocks.
So what this study really proves is that a winning edge exists. It's there. But knowing the rules for one trade is just the first step. The next, and honestly much harder question, is how you manage this across an entire portfolio, right? How much do you bet on each trade? How do you juggle dozens of positions at once? That's the critical next challenge this research leaves us with, and it's what separates a good idea from a great real-world strategy.